Disney is down 8% after they reported earnings, and this is when people typically they go and they just buy the dip because Disney is down 8 or 9%. But maybe Disney got 8 or 9% less expensive instead of getting 8 to 9% cheaper. This is what I try to do in these videos. I try to look at the valuation model, review the earnings, some problems with the companies, and try to come up with a very fair price where we could potentially double our money over the next 3 to 5 years with a stock like Disney. Now, looking at Disney's earnings, it was actually not really bad at all. They pretty much met the EPS expected of 93 cents per share. Revenue was, a little bit of a miss, but it wasn't too bad. But the main thing with Disney was actually the, subscribers, the Disney Plus subscribers. It came on at 157.8 million versus 163.17 million, which was expected. This is a pretty big miss for a company like Disney and all the investments that they are trying to put in, Disney Plus. Now you're suddenly gonna have people in the comments that are a little bit emotional. They're gonna say that this is because of what's happening in Florida, that this is why Disney is losing subscribers. And I agree, maybe it has something to do with it, but it's not gonna be the only reason. Because if you look at Paramount, you look at all these other streaming companies, all of them are crushing like never before. So in my opinion, yes, some of it has to do with what's happening as Disney Plus, but it's also mainly, people just get bored. Like they put on Disney for 5 or 6 months, then they switch to something else, or they share passwords with friends. They do many other things, which is why streaming is not as profitable and it's not as exciting of an industry as these companies claim for it to be. And I believe the smartest guy between all of them is actually Warner Brothers Discovery's CEO. He actually said, we're not trying to win the streaming war, but Disney and Paramount have a different opinion, and they've been trying to heavily invest in content to retain a user for a month or two until he switches to something else, because people get bored and, all kind of things. So this is why Disney, in my opinion, is losing, some subscribers, actually not meeting the expectations, which is really not bad, but they are putting in a lot of effort in this. And if you look at the revenue change for Disney, it doesn't really have a revenue growth problem because the company has been growing revenues. Sometime it grew 17%, 22%. It is expected to grow around 9% for 2023, which is actually not bad at all. But Disney actually has a profitability problem. And if you look at Disney before 2019, before they embraced the Disney Plus and they want to win the streaming war and all these kind of things, Disney's operating margins were around 24, 25 to 26%, which was pretty amazing. Disney was very, very profitable. And if you look at after 2019, those operating margins were stuck around 5.5%. Now it improved a little bit in 2022. It's around 8%, but it's still, again, not what Disney used to be. Disney used to be very, very profitable. Now it's not as profitable as once it was. And I hope they do something about not heavily investing in Disney Plus and doing, smarter things with the money they're trying to spend. But the good news with Disney Plus and the direct-to-consumer business for Disney, the losses are actually starting to narrow a little bit from 887 to 659 in 2023, which is actually an improvement, but they still have a long way down to go, maybe not before 2024 or maybe even late 2025 for Disney's direct-to-consumer business to even become profitable. So I'm not a big fan of what Disney is trying to do with winning the streaming war and direct-to-consumer. People get bored, they switch to something else, they go out in summer, they do something with their life, and I believe Disney is wasting a lot of money in this area, and I hope they actually, wake up to this reality and maybe do something about it. Now, if we look at the PE ratio for Disney, now it's sitting somewhere around 21 times earnings, but I took in the average pre-COVID for Disney because they had a massive spike in COVID and it messed up all the mean, numbers in terms of, PE ratios and stuff. But if we look at Disney before, COVID, Disney was much more profitable, as we talked about. We looked at the operating margin. They were much, much higher. But even the valuation was much, much lower. Disney traded at an average of 16.5 times earnings from 2008 to pretty much 2019. 16.5 times earnings, and they were much more profitable. Now Disney is much less profitable, and they are trading at 21 times earnings, which to me doesn't make sense at all. I don't know why. Why would I go go and buy Disney stock if there's so many different opportunities in this market with companies that are actually doing the right thing, they are not getting affiliated in the political space and many other things, and they are trying to do what's best for shareholders, which is what I want in these companies. And Disney is clearly not trying to do that, and the stock is not like it's priced in like it's going bankrupt or anything. It used to trade at 16.5 times earnings. It was much more profitable. Now it's trading at 21 times earnings, and it's nowhere as profitable as it once, used to be. And we can clearly see it with the company's return on capital. They used to return 19 to 20% on capital, and after they started Disney Plus, they returned like 2 to 4% return on capital. For 21 times earnings, this is very, very expensive. But what I try to do, I try to go through my own valuation model to try to determine a fair price for Disney. And Disney made around $82.7 billion of revenues in 2022. I put in 6% revenue growth for the next 5 years from 2023 to 2027, although the analyst expectations are a little bit higher, between 9%, 6%, 5%. So I put in an average of 6%, which I believe is a very, very fair number for Disney. Now, I made a mistake here because the net income margins for Disney right now are around 9%. I put in an expansion in net income margins to 12%, assuming that Disney Plus and the direct-to-consumer business actually does become profitable by 2027. So I put in a net income margin expansion from around 9%, 8 to 9%, to around 12%, which I believe is more than fair for the company. I put in 21 times earnings, which I believe is expensive, but I use the same PE they're trading at right now, 21 times earnings. This would only come up with around 59% on the upside, or 10% compounded every single year for the next 5 years. Disney's dividend is not the best in the world, and there's not much in terms of buybacks. In fact, if you look at the shares outstanding, they expanded from 2018 to 2021, and it went down a little bit in 2022, but no major shareholders yield or shareholders return. So for me personally, Disney is still expensive at such prices, even though if the stock went down 8 or 9% in a single day, it doesn't mean that Disney can't get more expensive. It doesn't mean that this is the top in Disney or I'm trying to time the bottom. But my own valuation models tell me that if I want to double my money over the next 5 years with Disney, I have to buy it somewhere around $76 per share. And Disney is now trading at $92 per share. And $76 per share is somewhere, close to the October lows. It's pretty much lower than what it traded at in, March 2020, which I'm not sure if Disney will go there. But I would personally not pay more than $80 per share for something like Disney. And if I had to choose between Disney's and other opportunities, Disney is very expensive related to other opportunities that you can actually find in the market. So for me, again, Disney is not a buy. It doesn't mean it can't recover on some technical terms or anything, but I just believe the stock is expensive and I think there's better opportunities in the market. So thank you for watching this video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.